everyone. So we'll be studying financial management. I am Juhi Gupta. I have done my MBA in finance and marketing and with operations. So financial management. Now this is a term or this is an aspect which you come across almost on a daily basis. Let's say you have got 5 rupees with you and you want to eat something from outside. Alright. Then you decide that you want a packet of chips. However, this chips cost rupees 10. Okay. So now once you have decided what you want to do, the next question is, do you have enough money to do it? Now in this case you don't have enough money because you have only 5 rupees. How much do you need? You need 5 rupees more. So you try to find out ways in which you can get these 5 rupees. So you go ahead and ask your friend if he or she will give you these 5 rupees. Okay. They say and ask, what will I get in return if I give you my 5 rupees? Now you can tell them that either I can give them back to you, alright, or you can say that I will give you 50% of the chips that I will purchase. Okay, so I will share my chips with you, I will give them back, or something, right? So these things that you do, like when you decide where you want to invest your money, when you find out what is the kind of money that you need and where will you get it from, why will someone give you this money, all these aspects are essentially the different aspects of financial management. In very simple terms, financial management is what? Nothing but the management of financial resources. Alright, and this is primarily what we will study in this subject overall. So the first thing is where to get the money from. In this case it was your friend. Where to invest the money, the investment decision, that is your chips to eat. And how much to distribute among shareholders to keep them satisfied, which was because you had asked for 50% of the money from your friend, so you will give them 50% of chips. So this was the dividend decision. Okay, so these three aspects, financing decision, investment decision and dividend decision, these are the three aspects of financial management. As I said, the very basic definition can be it is the managerial activity which is concerned with planning and controlling of the firm's financial resources. Okay, financial management takes care of planning and also controlling. Okay, so financial management is the planning and controlling of the firm's financial resources. This is a very basic, the simplest definition that can be. Alright. Now, how does, if you are an entrepreneur and you want to start a company, what all decisions or what is the cycle, stepwise cycle that you will do planning the finances? So these are the 4 stages. First of all, as an entrepreneur, you will decide which assets you need to buy. Alright. Take your example again. This is the same as your chips because you wanted to eat something. Stage 2, when you determine what is the total investment required for buying these assets. In your case, this was the rupees 10. Okay. Then for starting an organization or a company, okay, you need to decide that apart from these assets, would you also need some extra money? How much cash do you need? Alright. Or what is the working capital requirement? In your case, because it was a simple packet of chips, this step was not required. It was only 10 rupees that you needed. Now, next stage, the stage 4 for any entrepreneur would be to decide what all sources does the entrepreneur need to tap to finance the total investment. That means from where all he or she can earn or borrow or get the money. Okay, so these sources can be different sources. In your case, it was your friend and he or she gave you the money in return for 50% of the chips, half chips, right? In the case of finance, or in, when starting an organization, these sources can be share capital, that is the entrepreneur's own fund, also like equity share capital, okay, or borrowing from some of the banks or investment from any financial institutions. They can be loans, they can be money for, a share of profit or something. So we will study all these aspects in detail. But these are the four stages whenever you are an entrepreneur starting an organization. These are the four stages that, will determine your financial management cycle. Now the, detailed definition. Now, financial management comprises of, see, we studied that it takes care of planning and controlling, right? Now what are the different aspects of planning and controlling the financial resources? So planning and controlling would include forecasting, wherein you say that, okay, for the first year of my operations, I will need, let's say, 1 crore rupees, and then second year, I need another 50 lakh rupees for running, and therefore, the overall capital that I'm looking at is 1.5 crores. Okay, so forecasting. Next stage is planning. Why? Because let's say you have 1.4, you want 1.5 crores, then you need to tell people that, okay, what part of this, part of this money will go into my assets, what will go into my raw materials, what will be going into my finished goods. Alright, so therefore you need planning. Next is organizing. Organizing again would be that in assets where all you will organize how much money and what would be the workflow. Directing, that which section, right, of your organization, which unit needs how much money. Coordinating, so that all these different steps are taken care of all these activities are done in a proper manner, all right, and there's no hindrances. And controlling all the aspects. Now, all these aspects, actually, all these activities, they do two things. And what are these two things? They are in terms of financial resources, but acquisition and application. So basically, where all you will get the money from, how you will get this money. Okay, acquisition takes care of that, and application. Once you get the money, as I said, where you will apply it. Okay, whether you will buy assets, you will buy raw material. Alright, the different applications of the finance resources and of an undertaking in keeping with its financial objective. The reason why you are working so much on the financial resources is to ensure that you get your financial objective completed. That, okay, I am looking at an investment of 1.5 crore rupees, but my objective is that this will give me, let's say, 3 crore rupees by the end of second year. Alright, so whatever is your financial objective, it should be in line with all these activities. So now, going through the definition, financial management comprises of forecasting, planning, organizing, directing, controlling, and coordination of all activities relating to the acquisition and application of financial resources of an undertaking in keeping with its financial objective. Okay, you can also say that financial management is concerned with the managerial decisions that result in the acquisition and financing of short term and long term credits for the firm, right? I had mentioned, like, in the first year you need 1 crore rupees for, for setting up your business and everything, and in the second year you said that you need 50 lakh or zero point 0.5 crore rupees for management of all things. So this is only for 2 years. But what if you have a 5-year plan, right? Or what is the long term credit, what is the short term credit? Everything will be included in the financial management only. Now we'll take the example of a manufacturing company. Let's say you want to start a manufacturing organization. Okay, and we will say how much money you will need, where and how you will procure it, and what are the different aspects that can be related to this financial management and your subject. Now, now the first question that comes into our mind as soon as we start thinking about a business is money. Where is the money going to come from? How you will procure it? How you will get the money? Okay, what will you do? How you will manage this money? Where all will you spend this money? If you will borrow the money from someone, why would they give you the money? All right, so let's see. So because you have a manufacturing company, all right, you will first calculate what is the total money that you need, right? Now this money will be in terms of fixed assets. And what are these fixed assets? Your fixed assets are, they can be plant and machinery. Let's say 20 lakh rupees. Okay. Next, you would need a place. Okay. So what you need is land and building to set up your plant. This might take around 40 lakh rupees. Another thing that you will need is furniture and fitting. Let's say another 10 lakh rupees. Now the question is, will it be enough for you to get the money required for your fixed assets only? You know very well that it will not. Let's say you have all these things. What will you do? How will you create products? Do you have any goods? Do you have any raw material? No. What if something wrong happens? Do you have any cash with you? No. Therefore, you would want to have some money in your working capital. What is working capital? Basically, fixed assets is the money which you need to invest in the first time, right? All these things. However, there would be requirement of a money for items which will be required from time to time. These list would include stuff like having some finished goods and some raw material. All right. So let's say you need to keep finished goods of worth rupees 10 lakh, raw material another 10 lakh rupees, and you need to have some money to save for the uh, for an off day, another 10 lakh rupees. You also need this cash in order to ensure that your cycle keeps going. You keep getting more finished goods, more raw material in case there is any payment delay. Right. So overall, you can see that overall fixed assets you need around 70 lakh rupees and the working capital you need around 30 lakh rupees. Okay. So the overall money that you need for your business to start and run so far is 100 lakh rupees. Alright. Now the bigger question that you now have to answer is, all right, I know where all I need to invest, how much money, and how much money do I need for plant machinery and land and for finished goods and raw materials. But the question is, where will I get this money from, right, in order to start your company? Now, as we had found out, the total project cost, okay, is 100 crore rupees. I'm sorry, the total project cost is 100 lakh rupees. Okay. and now I need to get this money from somewhere, because you are the one who's starting this business. Okay, where will you get this money from? There should be some amount. There will be some amount that you already have with yourself, let's say 30 lakh rupees. Okay, and you want to invest this. Now this is your, because you are the owner and you are investing. So this money is the equity share capital. All right, this is the equity share capital that the owner is investing. Once you're investing this money, what is the reason? What do you have in mind? Why are you investing this money? Because you believe that at the end of the year this will give you some profit. But is 30 lakh rupees enough? No. This 30 lakh, apart from this 30 lakh, you also need another 70 lakh rupees. So you decide that okay, for another 30 lakh rupees, I will issue some debentures, okay, and release them in the market so that people can get them and I can get the money. Now, what do these people get in return for these debentures? They get an interest. Okay, they invest money in buying these debentures and they get an interest. But is that enough? Now you have 60 lakh rupees. You still need another 40 lakh rupees. So where will you get these 40 lakh rupees from? There may be other sources. For the scope of this discussion, we will assume this to be a bank loan. All right. So you have three sources from where you get your project cost, the overall money that you need, which is 100 lakh rupees. Now, even though we have used capital only, in the term of equity share capital, please understand that for all financial management issues, right, the complete 100 lakh rupees that is helping you in your business will be capital. Okay, this is complete. This completely is your capital. Now, in return for your equity share capital, you get some profit. In return for the debentures, the people investing in debentures, they get some interest. And similarly, in return for the bank loan that you get, the bank also receives some interest. It may be at whatever percent. Okay. Now, when we had started this example, I told you that we will also understand how does this example relate to the different topics that we are going to study. Right? This we have understood that for running a business, this is what all kind of money we require. Right? So, when you decide, that where you need money and how much you need money, right? On what basis have you decided that this 20 lakh rupees is where how much money you are deciding need for your plant and machinery, or whether you want to buy a land and building, or you are taking it on lease, whether you are investing in furniture to keep it as a asset permanently, or you are just renting it out or leasing it. Similarly, what is the quantity of finished goods versus raw material that you are going to keep, and how much cash you will keep yourself. So these all these decisions need to be made properly, right? And on what kind of business you are running, and you need to take a lot of factors into consideration. And all these things, all these decisions, we will be making under the chapter of capital budgeting. All right. The whole topic of capital budgeting, the whole section, we will be studying such problems. Now, once you have decided where on you need to invest how much money, then you had decided that okay, where I'm getting my money from. All right, all right. And in this case, it was that you had decided that the sources are equity share capital, debentures, and bank. So these, that how much money you will get from which source. Okay, this determines your capital structure. Alright. Then you had decided that okay, in return for this capital, the equity share capital that I'm investing, I need a profit of, let's say, A%. Okay. So whatever you are getting in return, all right, whether it is yourself or the people who have invested in debentures or the bank, all right, this whatever you get in return is the cost of the capital. Okay. So capital budgeting would determine the different, decisions of your project, how where you are going to invest, how much working capital you need. All right, all these things will be under capital budgeting. The capital structure will determine where you are getting this money from. All right, what are the sources, how much money from which source. All right, and the cost of capital will determine that in return for this capital that you are raising or getting, what is the return that you have to give, whether it is an interest, a profit percentage, or whatever. Another aspect would be, let's say, this working capital, right? How do you decide in capital budgeting what kind of money do you need? So this will come under working capital management. Another thing is, let's say you say that all right, I because I'm investing whatever equity, so as the owner I need X percentage profit. All right, let's say it is 40%, and the profit generated in a year of the organization is more than this. All right, actual profit is more than what is required. So if there is surplus, whether you will divide it among the owners or you will reinvest it in the business. So this aspect is dividend decisions. Okay. Then there's also the fact that how will you decide whether you want to do a business altogether or not? Now, whether you want to do a business or not, it depends on two things. Let's say your business project will give you a return. This return is called return on investment because you, as the owner, are investing something, right? And this will give you a return on your investment. So, let's say the project will give you a return on investment of 25%. Alright. Now, because apart from your own investment, you are also taking money in terms of capital from other people, and this money was coming at a cost which we had determined in cost of capital, right? So this cost of capital also has to be borne out, okay, by the business itself. So then you need to determine that apart from the return on investment that I might be generating, what is the cost of capital? Because very simply, if the cost of capital is more than the return that you're going to get, it does not make sense for someone to make this to do this project. Because if the cost of capital is 30%, you will have to bear this cost from the owner's pocket. So in that case, it may not be wise to do such a business. However, if the ROI is 25%, if the return on investment is 25%, and the cost of capital is somewhere, let's say, around 20% only, in that case, you will be saving some money. And so it might make sense for you to do the business. So these are the various aspects that we will study in the financial management.